Welcome to SIRA MCQ YouTube channel. Today we discuss advanced level A-level accounting paper 2025 question number 10. Look here, there is a one question but they request us there are two identification. Look here, what are the requirements? Look here, the correct gross profit, correct one. Look here, we can think about that correct gross profit. In that case, we can identify what is this incorrect gross profit is there. They already calculated incorrect gross profit. Okay, they need correct gross profit and net profit for the year ending 31st March 2025. Correct gross profit and both of them correct net profit. Look here, I prepared a schedule to identify the gross profit and net profit. What is this? Income statement. Look here, income statement. Income statement. Income statement. You know what is the schedule of income statement? Firstly, sales minus cost of sales. After that, we can calculate gross profit. This is our requirement. Gross profit. After that, we plus add other income. After that, we minus which one? Expenses. Okay, after that we can calculate net profit. This is the requirement. Okay, this is the schedule we prepared. What is that? Income statement. Sales minus cost of sales, gross profit, other income, expenses, and we can calculate net profit. This is the schedule of income statement. This is the normal rupees. Okay, let's see the question. Look here, Amali traders reported a gross profit. Look here, gross profit 250 and net profit of 180 for the year ending 31st March 2025. In this year, they calculated gross profit 250 and net profit 180. We must include these 250, 180. Gross profit is 250, net profit is 180. This is the already calculated gross profit and net profit. This is the incorrect values. Why? Look here, this is the question. There are some errors identified. Look here, Amali traders sells goods. They sell some goods by keeping 25% markup on cost. 20% markup on cost. The basement is cost. Okay, during the month of March, this is our period end month. Okay, during the month of March 2025, the business dispatch means issued. Okay, issued goods costing 15,000 on sales or return basis. Look here, this is issuing stocks on look here, this is the major point, sales or sales or return basis. Return basis. This is the basement. Okay, we issued some cost, dispatched some goods, sales or return basis. Okay, what is the information there? Look here. There's a value there. Look here. The business dispatched issued goods costing 15,000. Okay, costing 15,000. What is the cost? This is the issuing. This is the issuing. This is the issuing some goods. Cost. Cost is there. Cost is 15,000. You know, we can create a selling price. What is that? We add gross profit. Gross profit in this stock. Okay, gross profit. Add gross profit. After that, we can calculate selling price. Selling price. Selling price. Selling price. Okay, we can calculate gross profit and selling price. What is the basement? What is the information? Look here. Trader sells goods by keeping 25% markup on cost. 25% markup means gross profit. Okay, on cost. Okay, therefore I calculated gross profit based on cost. Okay, we add 15,000 into 25%. 3,750 is gross profit. We can calculate the selling price 18,750. This is the selling price. This is the schedule of issuing total. This is the total issuing. Okay, this is the information. This is the information. Okay, there is a issuing some goods. What's the next point? Look here. However, the entire sales value. Look here, entire sales value. Sales value means what's the value? Sales value. Entire sales value is this. Entire. This is the total sales price. Sales value 18,750. 50. Look here. Of these goods has been recognized erroneously as sales revenue by the business. As sales revenue by the business. You know, they already calculated net profit and gross profit. At the calculation, they erroneously identify the sales of which amount. This is the error sales there. What is the amount? 18,750 was identified. This is the error value. 875 is already identified as a sales. Okay, in that case, you know, this is the normal rupees. We must identify that with normal values. This is a gross profit 250,000 and 180,000. This is the error values. You know, this is the sales value impact to gross profit and both of net profit. This error sales 18,750 already add to top of this. Therefore, this 875 value was included there and included there. Why? This is the top of this. This is the head. Included to head. This weight was impact to this side. This side means this is impact to gross profit and this is impact to net profit. This is the leg side. Okay, impact to this side. Okay, let's see the question. Already included, already revenue identified. Look here, sales revenue by the business. Okay, look here, by out of these goods, out of this is the total of these goods are there. Out of these goods costing 5,000 remained unsold. Look here, unsold as at 31st March 2025, and no adjustment has been made in this respect in the books of accounts. There is a out of this total stock, goods costing 5,000 remained. 5,000 cost of the goods remain unsold. They are not sold. Unsold as at 31st March 2025. You know, look here. This is the requirement. This is the total one. Out of this 5,000 cost. Look here. Costing 5,000. No, costing 5,000. Cost there. This is the cost. This is the unsold goods are there. This is the unsold goods there. Unsold goods. What is that? 5,000. Look here. You know the total is 15,000. 1/3 of this. Look here. 1/3 of is 5,000. Divide 15,000 divide in 3. Look here. 1/3 is 5,000. Therefore, I calculate gross profit of 1/3, selling price of 1/3. Okay. Sorry. 3 of 1. Okay. 1/3. Look here. I divide in 3. Okay. 1, 2, 5, 0. And identify 1/3. 1/3 of this. This is 6,250. This is the unsold goods. Okay. Unsold goods. Okay. Let's see. Their account. Look here. The closing inventory means at the end of the year the remaining stock. Closing inventory of the business as at 31st March 2025 ending date has been ascertained. Ascertained means identified, accounted. Ascertained means identified, accounted. Look here, accounted based on physical stock, and it did not include these unsold goods. Look here, you know what is the double entry for closing stocks? You know, closing stocks are, what is the double entry? I prepared there closing stocks. What is the double entry of that? Double entry. And what is the destination? Final destination. What is the double entry? Closing stocks debit. Closing stocks debit. And trade account or purchase account credit. This is the double entry. What are the destinations? Closing stocks debit is final destination is SOFP, statement of financial position. We identified in current assets as closing stock. Closing stocks there. Okay, and the purchase is credit, trade account credit. It must be included to where? Do you know there's a cost of sale calculation? You must deduct from there is the closing stock. closing stocks. This is the destinations of closing stock. This is the minus deduction. Okay, what are the destination of closing stock? Closing stocks debit, trade account was credit. Closing stock is SOFP, statement of financial position, closing stock, and credit should you must be include to closing stock, deduct from cost of sales. Okay, this is the closing stock double entry. And look here, what is they explain? They explain that closing inventory of the business as at 31st March 2025 had been ascertained, identified as physical stock. Physical stock means actual counted stock in business area. Physical stock means actual counted stocks in business stock, and it did not include these unsold goods. You know, there is a unsold goods there. What is this? There is a two impact of this. Look here, there is error of what are the errors? There is a unsold goods there. The unsold goods is there. In that point, the cost of these goods you must be identified as a closing stock. Why? These issued dispatched cost of these stocks is our control. Why? We issued some cost of goods. This is remained in not our business, in other business. Look here, this is our business. No, this is our business. We dispatched, issued some goods to our customer. This is the another seller. Small seller. Seller is small seller. Okay, small seller. In that case, we issued some goods, but they unsold 5,000 cost of goods. Cost of goods is unsold. Therefore, these goods are small seller in business. But we must identify in our business why this cost of goods must be identified in our stock. Why these goods are our stocks? Why? These cost of goods controlled, and the risk of the goods are already identified in our business. Why? The small seller can return it, sales or return basis. These remaining stocks, there is no risk to seller. No risk. Why? He can return it. He can resend it these goods. Remaining stocks, he can return it. There is no risk to small seller, but there is a risk to our business. Why? These goods can be returned. Okay, therefore we must identify these remaining stocks as our closing stock. Why? In that case, you know, they already accounted closing stock, but these unsold goods not identified. Look here, the closing inventory of the business as at 31st March 2025 had been ascertained based on the physical stock. Physical stocks means counted stock in our business. Only physical stock in our business, and it did not include, physical stocks did not include these unsold goods. Why? These unsold goods are there, small seller. Therefore, we must identify the as another 5,000 cost of goods as closing stock. Okay, already they accounted closing stock. Again, we must identify another closing stock as these 5,000. Okay, the physical closing stock is already accounted, and we must identify another closing stock 5,000. Okay, what is the double entry of closing stock? What's the double entry? Look here, we must identify the double entry. What is this? This is 5,000. Closing stocks debit and trade account credit. Okay, this is the double entry. We can identify it and adjust it. Look here, closing stocks debit. Again, this is impact to statement of financial position. Why? This is a debit, so destination is statement of financial position. Button, trade account, purchase account credit. This is impact to cost of sales. This credit 5,000 is impact to cost of sales. This credit short impact to cost of sale. This side. Okay, you know, remember that this gross profit is credit dial. Profits are credit dials. Net profit is the credit dial. In that case, you know, look here, this is the trade account and this one credit to cost of sale, the cost of sale area. This is impact to, look here, this is impact to what's area? To this area, cost of sale. What is the shorten? Credit 5,000 is impact to there. Okay, in that case, this impact is top of this, the gross profit. Therefore, the gross profit must be adjusting. Why? This is the gross profit is calculated sales and cost of sales calculation. In that case, this impact to cost of sale. Therefore, you can think this cost of sale already impact gross profit. Therefore, we must identify gross profit now. Therefore, this impact, what is the shorten? Gross profit is impacted. Okay, the top of the area is impacted. Therefore, gross profit was impacted. Credit 5,000. Gross profit is credit dial. Therefore, you must add. Why? Gross profit is credit dial. This short is credit short. You must add this. 5,000. Okay. After that, this credit short should be identified impact to net profit. Why? This is the top of the area impacted and the down area, this side is already impacted. Why? The gross profit should be impacted and net profit should be impacted. Short is credit short, credit dial, net profit is credit. We must add this. Why? Short is credit plus this. Okay, the credit short is impacted to this area. Therefore, gross profit must be impacted. Therefore, gross profit is credit short. This short is credit, should be done, should be plus. This one, there is a top of the area impacted. Therefore, the bottom is already impacted. Therefore, this credit short impacted to net profit. Therefore, credit short to credit short, we must add this. Okay, again, another one is, this is the wrong area. We identified what is this unsold good. You know, the selling price is already identified as a sales, but the selling price unsold area is there. Therefore, we must eliminate this unsold goods selling price. Okay, the closing stock was impacted 5,000. Why? Cost is impacted to closing stock, and the total sales value is not 18,750. Actual one is without 6,250. Why? This is unsold. Unsold. Therefore, we must eliminate these sales from sales. Why? You know, this is, look here. Erroneously, error sales identify as 875. But there, you know, there is no sales of unsold goods. Unsold sales price was 6,250. This is unsold goods. Therefore, you must eliminate this from where? Sales value. Why? Sales value is already identified 18,750, but unsold goods are there. What is this? Unsold goods are there 6,250. 6,250. Okay, you must eliminate it. At this time, I eliminate it. What is the double entry? Look here. You know, there is a overvaluation of sales. You must identify the opposite side. Why? This is the overvaluation of sale. What is the normal sales double entry? Sales credit, debtor control debit. Debtor control debit. They already identified overvalued this short. Why? 18,750. Therefore, you must identify an opposite side of this. Why? There is overvalue. You must reverse this. What is the reverse short? Sales credit now. Sales debited. Debit to sales. Sales debit. This is the reverse. And debtor control credit. This is the reverse of this. Reverse means error correction. What is the error correction amount? 6,250. 6,250. You must be corrected. Debtor control is impacted to statement of financial position. This is not impact to gross profit or net profit. Debtor control. Sales debit. Look here. Sales debit is impacted. Sales debit. Look here. What is the short? Sales debit. This is impacted to their sales debit. Sales is impacted to gross profit. Why? This is the top of their impacted. Top of the area impacted. Therefore, gross profit was impacted. Sales was debit. Gross profit is credit dial. But this short is debit. You must be deducted. 6,250 must be deducted. Why? This is the debit short. All debit short should be deduct. All credit short should be add. Okay, credit add, debit short minus. Okay, after that, this is the top of the area was impacted. Therefore, net profit should be impacted again. 6,250 should be deduct from net profit. Okay, this is the impact. What is the answer? This is the correct one. This is the impact. 250,000 add 5,000 and minus 6,250. 248,750. This is the correct gross profit, and correct net profit should be 1,780. 178,750. This is the answer of this. This is the correct gross profit is 248,750, and correct net profit was 178,750. What are the answers? 248 248 750 is there. 248 750. There are three answers. What is the net profit? Net profit is 1178. 178 750 is the answer is 3 for question number 10. Answer is 3 for question number 10. In next video we can calculate the answer of question number 11.